There's a pattern in history that has destroyed three major currencies in the last 1,700 years. And right now in 2025, the United States dollar is following that exact same pattern wave by wave, trillion by trillion, almost like central banks are reading from a script written by Roman emperors. In 301 AD, Rome had the strongest currency in the world. The denarius had been stable for 300 years. Within 50 years, it was worthless and the empire collapsed into chaos. In 1600, Spain controlled half the world's gold and silver. The Spanish real was the global reserve currency. By 1650, it had lost 75% of its value and Spain descended from superpower to irrelevance. In 1923, Germany's papiermark was the currency of Europe's most advanced economy. Within 18 months, it took 4.2 trillion marks to buy $1, and the currency ceased to exist. 3 times. 3 currencies. 3 complete destructions, all following the exact same 4-wave sequence. And here's what should terrify you. The US dollar has already completed 2 of the 4 waves. We're not approaching inflation. We're in wave 3 right now. This is the story of how currencies die, why governments always deny it's happening, and why the math says the dollar is next. And it's moving faster than any previous example in history. Before we go through the pattern, you need to understand what inflation actually is. Not rising prices, that's the symptom. Inflation is the destruction of currency value through expansion of money supply. When more money chases the same goods, prices rise. Not because goods are scarce, because money is abundant. And here's what nobody explains. Inflation doesn't happen all at once. It moves in 4 distinct waves. Wave 1, monetary expansion. The government prints money or creates credit. The new money enters the financial system first. Banks get it. Bond markets get it. Stock markets get it. Asset prices rise. Real estate, stocks, bonds, all inflating. But consumer prices stay stable. Most people don't notice. They see their home value rising and think they're getting richer. They're not. The currency is dying. Wave 2, asset inflation. The newly created money spreads from financial assets to hard assets. Real estate prices explode. Art, collectibles, commodities, all rising. The wealthy, who own assets, get massively richer. The middle class, who own some assets, feel okay. The poor, who own no assets, fall further behind. Inequality explodes. But consumer prices are still relatively stable. Food costs a bit more. Gas is up. But nothing catastrophic. The government claims inflation is under control. CPI shows 2%, 3%, maybe 4%. Manageable. This is the lie. Wave 3, consumer inflation. The monetary expansion finally hits consumer goods. Food prices double. Energy costs triple. Rent becomes unaffordable. Wages can't keep up. People start demanding more money. Unions strike. Workers quit. Businesses raise wages. Higher wages mean higher costs. Higher costs mean higher prices. The spiral begins. The government still denies there's a problem. They blame supply chains, greedy corporations, price gouging, anything except the money printing. But the currency is already dead. It just hasn't stopped moving yet. Wave 4, currency death. People lose faith in the money. They spend it immediately. They convert to foreign currency. They buy anything that holds value. Velocity of money explodes. Prices rise daily, then hourly. The government prints faster to keep up. Hyperinflation. The currency becomes worthless. The economy collapses. And the pattern resets. This has happened 3 times in recorded history to major currencies. Let me show you how it played out. Let's start with the first documented case of monetary inflation destroying a major currency. Rome, 200 AD to 350 AD. In 200 AD, the Roman Empire was at its peak. 65 million people. Territory from Britain to Egypt. The strongest military in history. And the denarius was the most trusted currency in the world. The denarius had been stable for 300 years. It was a silver coin weighing 3.9 grams. 95% pure silver. You could trade a denarius in Rome, Alexandria, or Londinium. Everyone accepted it. The value was guaranteed by the silver content. Not by government decree, by actual metal. But in 193 AD, Emperor Septimius Severus had a problem. The military demanded higher pay. The expansion had stopped. There were no new conquests bringing gold and silver. The treasury was running low. Severus needed to pay the soldiers without raising taxes. So he did what every government does when it needs money. He debased the currency. Wave 1: Monetary expansion. Here's how Roman currency debasement worked. The government called in denarius coins and melted them down. They added copper to the silver. A coin that was 95% silver became 80% silver, then 60%, then 40%. The weight stayed the same. The stamp stayed the same. But the silver content dropped. They took 100 coins containing 370 grams of silver. They melted it. They added 130 grams of copper. Now they had 500 grams of metal. They stamped it into 130 coins. Same face value. Less silver per coin. The government just created 30% more money out of thin air. And they did this repeatedly. By 215 AD, under Emperor Caracalla, the denarius was 50% silver. By 250 AD, under Emperor Decius, it was 40% silver. By 270 AD, under Emperor Aurelian, it was 5% silver. In 70 years, the denarius lost 95% of its silver content. The government had expanded the money supply by 20 times. Wave 2: Asset inflation. The newly created money flowed to the wealthy first. Senators, merchants, large landowners. They received government contracts. They collected taxes. They got the debased coins at face value before prices adjusted. And they spent it immediately on assets. Land, slaves, grain stores, anything that would hold value. Land prices in Italy increased tenfold from 200 AD to 280 AD. A farm that sold for 10,000 denarii in 200 AD sold for 100,000 denarii in 280 AD. But it was the same farm. Same size. Same productivity. The denarius had just lost 90% of its value. The wealthy understood this. They converted currency to assets as fast as possible. The poor didn't understand. They received wages in denarii and spent it on food. As long as food prices stayed relatively stable, they didn't notice the debasement. But that couldn't last. Wave 3: Consumer inflation. By 270 AD, consumer prices started exploding. Wheat that cost 10 denarii per bushel in 200 AD cost 100 denarii by 280 AD. Wine, olive oil, cloth, all rising at the same rate. Why? Because merchants weren't stupid. They knew the coins had less silver. They demanded more coins for the same goods. Workers demanded higher wages. The government paid in more debased coins. Merchants raised prices again. The spiral was underway. By 290 AD, the Roman economy was in chaos. Farmers stopped selling grain for currency. They hoarded it or traded by barter. Urban populations couldn't get food. Soldiers' pay was worthless. They started looting. Provinces revolted. And Emperor Diocletian, taking power in 284 AD, decided to fix the problem. Not by stopping the debasement, by controlling prices. In 301 AD, Diocletian issued the Edict on Maximum Prices. It set maximum legal prices for over 1,000 goods and services. Wheat, wine, meat, cloth, transportation, wages, everything. The penalties for violation were severe. Merchants who charged more than the maximum faced execution. Citizens who paid more than the maximum faced execution. Diocletian thought he could stop inflation by law. He was wrong. What happened next is economic inevitability. Merchants stopped selling goods at the controlled prices. If wheat cost them 150 denarii to produce but the legal maximum price was 100 denarii, they didn't sell. They hoarded it or fed it to animals. Shortages exploded. Black markets emerged. People traded goods illegally at real market prices. The government couldn't enforce the edict. There weren't enough soldiers to monitor every transaction. The edict failed within a year. Diocletian abandoned it. But the damage was done. Wave 4: Currency Death. By 310 AD, nobody wanted denarii. Merchants demanded payment in gold, silver bullion, or goods. The government tried to collect taxes in denarii. Taxpayers couldn't pay because their denarii were worthless. Tax revenue collapsed. The government couldn't pay soldiers. Soldiers mutinied. The empire fractured. By 350 AD, the denarius had ceased to exist as a functioning currency. It was replaced by the solidus, a new gold coin. But the solidus only circulated among the wealthy. The common people used barter. The money economy had collapsed. And the empire followed. Within 125 years of starting currency debasement, Rome went from the strongest economy in history to fragmented chaos. The collapse wasn't caused by barbarians. It was caused by inflation. Let's jump forward 1,300 years. Spain, 1550 to 1650. The Spanish Silver Crisis. In 1550, Spain was the richest empire on earth. After conquering the Americas, they controlled the silver mines of Potosi in Bolivia and Zacatecas in Mexico. These were the richest mines ever discovered. By 1600, Spanish America was producing 300 tons of silver annually. The Spanish real was backed by this silver. It was the global reserve currency. Everyone wanted Spanish silver. Spanish coins circulated in Europe, Asia, Africa. The empire seemed invincible. But Spain made the same mistake Rome made. They thought wealth came from money. They thought more money meant more prosperity. They were wrong. Wave 1: Monetary Expansion. Spanish silver production exploded from 1550 to 1600. 50 tons per year in 1550. 100 tons by 1570. 200 tons by 1590. 300 tons by 1600. This was massive monetary expansion. The money supply of Europe increased fivefold in 50 years. And Spain got it first. The silver arrived in Seville. The Spanish crown took 20% as royal fifth. The rest went to merchants and nobles. They were suddenly rich beyond imagination. Wave 2: Asset inflation. The Spanish nobility bought everything. Land in Castile. Palaces in Madrid. Estates in Italy. Ships and trading companies. Art, jewels, fine clothing. Land prices in Spain tripled from 1550 to 1590. A noble estate worth 50,000 reals in 1550 sold for 150,000 reals in 1590. The wealthy accumulated assets. But they produced nothing. Spanish nobles considered work beneath them. Manufacturing was for commoners. Agriculture was for peasants. The nobility consumed. They imported everything. French wine, Italian silk, Dutch manufactured goods, English wool. The silver flowed in from America and immediately flowed back out to pay for imports. Spain became a conduit. Wealth passed through but didn't accumulate. And here's the critical detail. Spain stopped producing. Why build ships when you can buy them? Why grow food when you can import it? Why innovate when you have unlimited silver? By 1600, Spain had almost no domestic industry. Everything was imported. Everything was paid for with silver. And the silver was running out. Wave 3: Consumer inflation. The monetary expansion finally hit consumer prices. In 1550, a fanega of wheat cost 400 maravedis. By 1600, it cost 1,800 maravedis. 4.5 times increase in 50 years. Wine, oil, meat, cloth, all rising at similar rates. Why? Because Spain imported everything and paid with silver. But other countries weren't stupid. They knew Spain had unlimited silver. They raised prices. Spanish silver bought less and less. And domestically, prices exploded because there was no production. More money chasing fewer goods. Classic inflation. Workers demanded higher wages. The crown debased the currency. They started minting coins with less silver content. Vellon coins, copper mixed with silver. The same debasement Rome had done 1,300 years earlier. By 1640, Spanish coins that were supposed to be silver were 98% copper. The currency was dying. Wave 4: Currency death. By 1640, nobody trusted Spanish currency. Merchants demanded payment in gold or foreign currency. The Spanish crown couldn't collect taxes. Revenue collapsed. They declared bankruptcy in 1557. Again in 1575. Again in 1596. Again in 1607. Again in 1627. Again in 1647. 6 bankruptcies in 90 years. Each time, the crown defaulted on debts. Each time, trust evaporated further. By 1650, the Spanish economy had collapsed. The silver mines were depleting. Production dropped from 300 tons per year to 150 tons. But the economy needed 300 tons just to function. The shortfall was catastrophic. Trade stopped. Manufacturing disappeared. Agriculture declined. Spain descended from superpower to third-rate power. And they never recovered. The lesson? Having the money printer doesn't make you rich. It destroys you. Let's jump forward 280 years. Germany, 1918 to 1923. The Weimar hyperinflation. This is the most famous example because it happened in a modern, industrialized economy with detailed records. In 1914, the German mark was one of the strongest currencies in the world. 1 mark equaled 4.2 marks to the dollar. Germany was the most advanced economy in Europe. Science, industry, engineering, all world-leading. But World War I changed everything. Germany borrowed heavily to fund the war. By 1918, the national debt had increased from 5 billion marks to 156 billion marks. A 30-fold increase in 4 years. Germany lost the war. The Treaty of Versailles imposed 132 billion gold marks in reparations. That's 442 billion in today's dollars. Impossible to pay. Germany tried to negotiate. France refused. In 1923, France occupied the Ruhr, Germany's industrial heartland, to seize reparations directly. Germany called a general strike. German workers refused to work for the French. Production stopped. But the German government still had to pay the striking workers. How do you pay workers when production has stopped? When there's no tax revenue? When you're already drowning in debt? You print money. Wave 1: Monetary expansion. The Reichsbank started printing marks. Not slowly, frantically. In 1919, 29 billion marks in circulation. In 1920, 68 billion. In 1921, 81 billion. In 1922, 1.3 trillion. The printing accelerated exponentially. By August 1923, they were printing marks in denominations of 100 billion. The presses ran 24 hours a day. They couldn't print fast enough. Wave 2: Asset inflation. The newly printed marks entered the economy through government spending and bank loans. The people who received them first spent them immediately. They bought anything real. Real estate, factories, farmland, gold, foreign currency. Asset prices exploded in mark terms. A Berlin apartment building worth 50,000 marks in 1918 sold for 10 million marks in 1922. But measured in gold or dollars, the price hadn't changed. The mark was collapsing. The wealthy understood this. Industrialists like Hugo Stinnes borrowed millions of marks at near zero real interest rates and bought physical assets. Factories, mines, shipping companies. They became billionaires. The middle class didn't understand. They held marks. They held bonds denominated in marks. They thought the government would fix it. They were wrong. Wave 3: Consumer inflation. By 1922, consumer prices were rising daily. A loaf of bread cost 160 marks in 1922. By mid-1923, 1,500 marks. By September 1923, 1.5 million marks. By November 1923, 200 billion marks. Prices doubled every few days. Workers demanded to be paid twice per day, morning and noon, because by evening, the morning's wages were worthless. People spent money immediately. They converted marks to goods, any goods, instantly. Velocity of money exploded. This is the hallmark of Wave 3. People still use the currency, but they don't hold it. Restaurants changed menu prices during meals. A meal ordered for 10,000 marks cost 15,000 marks when the bill came an hour later. Shops stopped displaying prices. Customers asked at the counter and prices were calculated on the spot. The government kept printing. Not because they wanted to, because they had no choice. Tax revenue was worthless by the time it was collected. A taxpayer owed 1 million marks in January. They paid in July. By July, 1 million marks bought nothing. The government received nothing. They had to print to function. Wave 4, currency death. By November 1923, the mark ceased to function as currency. Nobody would accept it for goods. Shops demanded foreign currency, gold, or barter. Farmers refused to ship food to cities for marks. Urban population starved. Workers refused to work for marks. Factories shut down. The economy collapsed. On November 15, 1923, the Reichsbank introduced the Rentenmark, a new currency. The exchange rate was 1 Rentenmark equals 1 trillion old marks. 1 trillion. The old marks were demonetized. Every savings account, every bond, every pension denominated in marks became worthless. A person with 1 million marks in 1918, enough to live comfortably for 20 years, had enough in 1923 to buy a loaf of bread. The wealth destruction was total. The middle class was wiped out. And here's what followed. The destruction of the middle class created the conditions for extremism. People who had saved, worked, and followed the rules lost everything. Their anger was exploited. Within 10 years, the Nazis rose to power. The hyperinflation didn't cause World War II directly, but it destroyed the social fabric that could have resisted it. The lesson? Currency destruction destroys more than money. It destroys society. Now let's look at the modern example. The United States, 2000 to 2025. This is the fourth test, and we're in Wave 3 right now. In 2000, the US dollar was the undisputed global reserve currency. 65% of global reserves were held in dollars. Every major commodity was priced in dollars. Every central bank held dollar bonds. The dollar was backed by the strongest economy in history. But the United States made the same mistake Rome, Spain, and Germany made. They thought they could print forever. They thought reserve currency status made them immune. They were wrong. Wave 1, monetary expansion. The expansion started slowly after 2000. The dot-com crash prompted the Fed to cut rates and expand money supply. Mild expansion. Then 2008 happened. The financial crisis. The Fed's response was unprecedented. Quantitative easing. QE1, November 2008. The Fed bought $1.25 trillion in mortgage-backed securities and $300 billion in Treasury bonds. QE2, November 2010. $600 billion in Treasury purchases. QE3, September 2012. $85 billion per month in purchases, open-ended. By 2014, the Fed's balance sheet had grown from $900 billion in 2008 to $4.5 trillion. A five-fold increase in 6 years. This was monetary expansion on a scale never attempted by a major economy outside of war. The money didn't go to consumers directly. It went to banks. The Fed bought bonds from banks. The banks received cash. They used the cash to buy other assets. Stocks, corporate bonds, real estate. The monetary expansion entered the financial system first. Exactly like Rome, Spain, and Germany. Wave 2, asset inflation. From 2009 to 2021, asset prices exploded. The S&P 500 went from 666 in March 2009 to 4,800 in January 2022. 7.2 times in 13 years. Real estate prices doubled. The median U.S. home price went from $216,000 in 2009 to $430,000 in 2022. Bonds rallied. The 10-year Treasury yield dropped from 4% to 0.5%. Corporate bonds, junk bonds, all rising. Bitcoin went from nothing to $69,000. Art, collectibles, classic cars, all inflating. The wealthy got extraordinarily rich. The top 1% owned 70% of the asset gains. The top 10% owned 90%. The bottom 50% owned almost nothing. They had no stocks, no real estate, no assets. They had wages. And wages weren't keeping up. This is wave 2. Asset inflation without consumer inflation. The CPI from 2009 to 2019 averaged 1.5% annually. The Fed said there was no inflation. They were measuring the wrong thing. Asset inflation was 15% to 20% annually. But the Fed doesn't include stock prices or real estate in CPI. So they claimed success. Low inflation, strong economy. Reality? The currency was being debased. The wealthy were accumulating assets. The bottom 50% were falling behind. Inequality exploded. And then COVID happened. March 2020. The economy shut down. The Fed's response made 2008 look small. They cut rates to zero. They launched unlimited QE. $120 billion per month. No limit. No end date. Buy everything. Congress passed stimulus. $2.2 trillion CARES Act. $900 billion December 2020. $1.9 trillion American Rescue Plan March 2021. Total fiscal stimulus, $5 trillion in 1 year. The Fed's balance sheet went from $4.2 trillion in February 2020 to $9 trillion by April 2022. They doubled it in 2 years. M2 money supply went from $15.5 trillion in February 2020 to $21.7 trillion in March 2022. 40% increase in 2 years. This was monetary expansion on a scale that made Weimar look restrained. And this time, the money went directly to consumers. Stimulus checks. Enhanced unemployment. Child tax credits. Rent moratoriums. Student loan payment pauses. Trillions of dollars flooded into consumer hands. The velocity was about to accelerate. Wave 3, consumer inflation. In 2021, consumer prices started rising. Not slowly, explosively. CPI went from 1.4% in January 2021 to 9.1% in June 2022. The fastest acceleration since 1981. But the real inflation was higher. The way CPI is calculated understates true price increases. Food prices rose 15% to 20%. Energy prices rose 40% to 50%. Rent rose 20% to 30% in major cities. Used cars rose 50%. Everything people actually buy became more expensive. The Fed claimed it was transitory. Supply chain issues. Temporary. It wasn't. It was wave 3. The monetary expansion from 2020 to 2022 had finally hit consumer prices. And once it starts, it doesn't stop easily. Workers demanded higher wages. The labor market was tight. They got raises. 5%, 8%, 10% in some sectors. Businesses raised prices to cover higher wages. Higher prices reduced purchasing power. Workers demanded more raises. The wage price spiral began. The Fed finally acknowledged the problem in 2022. They started raising rates. From 0% to 5.5% by 2023. The fastest rate increase since the 1980s. They stopped QE. They started QT, quantitative tightening, selling bonds. The goal was to drain liquidity and kill inflation. It worked partially. CPI dropped from 9.1% in mid-2022 to 3% by mid-2024. But the damage was done. And Wave 3 isn't over. Here's why. The government debt is now 36 trillion. That's 120% of GDP. The interest on that debt at 5% rates is 1.8 trillion annually. Tax revenue is 4.7 trillion. Interest alone consumes 38% of revenue. And the deficits continue. 2 trillion deficit in 2023. 2 trillion in 2024. Projected 2 trillion annually for the next decade. The math is impossible. The government cannot pay 1.8 trillion in interest and maintain spending without printing money. The Fed stopped QE in 2022. But they'll restart. They have to. When the next crisis hits, when the economy weakens, when unemployment rises, the government will demand the Fed act. The Fed will cut rates. They'll restart QE. They'll buy government debt. And the monetary expansion will resume. Wave 3 will accelerate. And here's what makes the current situation more dangerous than Rome, Spain, or Germany. The US dollar is the global reserve currency. 60% of global reserves. 85% of foreign exchange transactions. Every major commodity priced in dollars. When the dollar inflates, the whole world inflates. Other central banks hold trillions in dollar bonds. When those bonds lose value, those central banks lose wealth. They start questioning dollar holdings. They diversify to euros, yuan, gold. Demand for dollars drops. The Fed has to print more to fund deficits. More printing means more inflation. More inflation means less demand. The feedback loop accelerates. Wave 4, currency death. We're not there yet. But the path is clear. Let me show you the signs. Sign 1, de-dollarization is accelerating. China and Russia trade in yuan and rubles. Brazil and China trade in yuan. Saudi Arabia accepts yuan for oil. India buys Russian oil in rupees. BRICS nations are developing alternative payment systems. They're not abandoning the dollar immediately. They're reducing dependence. This is how it starts. Sign 2, central banks are buying gold at record rates. 2022, central banks bought 1,136 tons of gold. 2023, 1,037 tons. The most since 1967. Why? Because they're diversifying out of dollars. Gold doesn't pay interest. Central banks don't buy it for returns. They buy it as a hedge against currency collapse. Sign 3, the Fed is trapped. If they keep rates high, the government can't service debt. If they cut rates and restart QE, inflation accelerates. There's no good option. This is the endgame of Wave 3. Sign 4, velocity of money is rising. In 2020, velocity was at record lows. People held dollars. They saved. By 2024, velocity is increasing. People are spending faster. They're converting to assets. Real estate, stocks, gold, Bitcoin. Anything but cash. This is the transition from Wave 3 to Wave 4. When velocity explodes, hyperinflation follows. The timeline is accelerating. Rome took 150 years from debasement start to currency death. Spain took 100 years. Germany took 5 years. The US? We're 25 years into monetary expansion that started in 2000. 15 years of aggressive expansion since 2008. 2 years of massive expansion 2020 to 2022. If the pattern holds, Wave 4 could hit within 5 to 10 years. Maybe sooner. What's the trigger? Maybe a debt crisis. The government can't roll debt at affordable rates. The Fed monetizes directly. Inflation explodes. Maybe a geopolitical shock. A war, a pandemic, an attack. The government prints trillions in response. The dollar collapses. Maybe loss of reserve status. A major oil producer stops accepting dollars. Others follow. Dollar demand crashes. The Fed prints to maintain value. Hyperinflation. Maybe a banking crisis. Regional banks fail. The Fed bails them out. Trillions in new QE. Inflation reignites. Maybe something else. The specific trigger doesn't matter. The mathematics say wave 4 is coming. The debt is unsustainable. The printing is inevitable. The inflation is accelerating. The only question is timing. 4 times. 4 currencies. 4 monetary expansions. 4 asset inflations. 4 consumer inflations. 4 currency deaths. All following the exact same 4-wave pattern. Rome's denarius, Spain's real, Germany's mark. And now the US dollar. We've completed wave 1 and wave 2. We're in wave 3. Moving toward wave 4. The government denies it. The Fed claims they have tools. The politicians promise solutions. That's what Diocletian said when he issued price controls. That's what Spanish kings said when they debased the real. That's what Weimar officials said in 1922. They were wrong every time. Because you cannot print your way to prosperity. You cannot expand money supply without inflating prices. You cannot debase currency without destroying value. The math doesn't change. The physics don't change. Only the names change. And this time, the collapse won't be confined to one country. The dollar is the global reserve currency. When it goes, it takes the global financial system with it. Trillions in dollar-denominated debt. Billions of people holding dollars. Hundreds of countries with dollar reserves. All of it evaporating. The question isn't if wave 4 comes. The question is what triggers it, how fast it moves, and whether anyone will be ready when the dollar becomes the 4th currency in history to complete all 4 waves.